Welcome to the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy, such as the Deferred Sales Trust, is the best way to grow your wealth. I'm your host, Brett Swarts, and each episode I'm joined by some of the best financial independence and passive income wealth advisors in the world, where they share their ideas, deal stories, and inspiration, so together we can make complex tax deferral strategies simple and passive income plans achievable. Hey, I'm excited about our next guest. Is his second time on the show. He's actually the co-founder of the Deferred Sales Trust. He's on the Forbes Council top list. He's been a financial advisor for 25 years. One of my favorite parts, though, he played for the San Francisco 49ers. And growing up playing football, that was one of my favorite things. And I actually grew up in the Bay Area, and I kind of followed Jerry Rice and Joe Montana, and I call it the glory days of the 49ers. And so Mr. Robert Binkley actually played with Jerry Rice and Joe Montana. And so I'm excited to have Bob back to the show. He's a good friend, mentor, business partner, and we're going to dive into the Deferred Sales Trust today on a little bit deeper dive. And so, hey, Bob, welcome to the show.
Thanks, Brad. Good to be here this morning. Hope everybody's doing well out there and staying safe.
Absolutely. We're in the middle of the corona crisis. For those who are maybe listening to this for a different time, it's now April the 4th. And, we're trying to find ways to kind of navigate everything that's going on here. And we're hoping to we really believe the Deferred Sales Trust is a solution for so many challenges that people are happening right now regarding having too much debt, needing diversification, needing liquidity. And so I'm excited to dive deep with Bob on some of those issues right now. So hey, Bob, let's just jump right in, since the listeners can go back to the, I think it's episode number 5, where you can hear Bob's kind of full story to kind of get the introduction. But let's just dive right into the Deferred Sales Trust, Bob. I'm curious, one of the top questions that a lot of people have is, how does the Deferred Sales Trust really help individuals break free from capital gains tax without having to worry about a 1031 exchange or any other tax deferral strategy for that matter?
Well, I would say the 1031 is a structure that's been around since the 80s, 85, 86, around that time, and a lot of people have utilized it for great success. I mean, they bought property, they continue to trade into other properties. At some point in time, you kind of hit a peak, when the chart goes as high as it can go, and it may trend down. And obviously we saw that in the stock market just recently with the coronavirus issues and a lot of the fear that's going around. So we think that, there's always a correction in any asset class. So the 1031 is, you just don't continue to exchange to the sky. At some point in time, you want to get out. And whether you're a younger person that just thinks this is the time to get out and get liquid and get diversification, or you're a baby boomer like I am, and you're starting to kind of think towards retirement down the road, it's coming, you can see that, and you want to just kind of get more secure, get your money in more diversified asset classes and be more protective. And so whatever your goals are, the Deferred Sales Trust can accommodate that. We think that the exchange is a great thing, but yet it has its limitations. So most of our clients, at some point in time, want to get out and utilize the DST to do that. And I look at the DST as our method of giving people liquidity, diversification, and tax deferral all at the same time. And you still have the option of going back into real estate down the road, which is, again, that might be your goals, is that you want to get out and wait for a correction in the real estate market and have a time to go back in. So that might be something that you want to utilize the DST for, or you ultimately want to just stay out of real estate.
Yeah, and walk us through that, Bob, a little bit, because I know one of the biggest challenges, I think, for people who are coming for the first time into the Deferred Sales Trust is they're so used to this idea of having, absolute control, meaning they're selling their asset and they're an owner, and they're exchanging to another asset and they're their owner, and they're, kind of all doing it themselves in that sense. And this idea that for some reason you can't also have that with the Deferred Sales Trust because you're shifting to a lender, right, which is different than an owner. So walk us through this idea of control, and or just buying real estate as you would, except there's a little bit of a shift with the partnership with the trust. Could you kind of walk us through that?
Yeah, so So first step is really the deferred sales trust is an installment sale. Installments have been around for 85, 90 years. So it's very well in the code. We do it exactly the way the IRS, you know, allows us to do it. So if you owned a property that has a highly appreciated, gain in there, and you don't want to pay tax, our trust that gets formed, it's not a pool trust. It's an individual trust that gets set up by the trustee that buys your asset for the price that you want to sell it for, and then it resells that asset for that same price. So ultimately, let's say your basis is 1 million. Today you could sell for 3 million, hypothetically. I'll just use that number as example. So the trust will buy it from you for 3 million and turn around and sell it for 3 million again to get the cash. So again, you're selling under an installment to the trust, and then the trust actually resells it for 3 million because it stepped up its basis for 3 million. So your basis might be 1 million, but when the trust buys it from you, it's going to buy it under 100% financing, or maybe 80% financing and give you 20% cash, whatever that might be. But most people like the idea of installment with 100% because they ultimately would like to not have to pay all the capital gains or any capital gains up front to the government. So the government understands that. And so what we do is we buy it from you for 3 million, and we turn around and liquidate it for 3 million. So instead of you being secured against the property that you once owned, you're now secured against $3 million of cash that needs to be invested into different types of investments. And those different types of investments could be stocks, bonds, mutual funds, annuities, ETFs. We use a lot of hedge positions that can hedge in these volatile markets. And more importantly, you can even go into trust deeds if you like trust deeds, and lend against real estate if you're really like the real estate. So there's all sorts of things that could be invested in, and you can certainly be as conservative or as aggressive in that trust as need be. So our goals are to give you the option of living on the full 3 million and getting income off the full 3 million versus having to pay maybe $750,000 of tax and living on 2,250,000. I like the idea of living on 3 million versus 2,250,000. An extra $750,000 to live on is very important to us taxpayers. And you have a legal right to do that. So, we like to be able to give you that liquidity, diversification, and more money to live on. That's what the DST brings to the table. And as a lender, a lot of people think, am I giving up control? Well, ask yourself this question. When you borrow from the bank and they're making a loan, did they give up control of their money? You bet not. They actually control their money with loan, covenants. They control their money with, protection of like trust deeds, first trust deeds on your property. They can even have you personally guarantee it. I mean, there's all sorts of guarantees that they have here. In our trust, you've got collateralization of cash. I mean, there's no better collateralization is to know that you're secured against, in this case, in this scenario, $3 million of cash. And then again, any investments that get made that are proposed investments, you as the creditor would have to approve in writing. So no monies could be put into any investments and any options without your signature. So that gives you the authority of protecting where your money goes. So again, we try to do everything that we can to ensure that your money is safely safeguarded. And again, inside those trusts, they get professionally managed. So again, you can approve the scope of the manager and let the managers do what they need to do internally, but those managers understand your risk tolerances inside the trust and what you would prefer as a creditor. So all the investments that are made inside that trust would really be really to your risk tolerances as a lender. We don't want to go off and gamble with that money so that that you would lose that money. I mean, again, there is risk. It's not that you have no risk here. You have the risk that's basically approved by you and the degree of risk that's approved by you. So just so you know, you have a lot of control here in this transaction.
Yeah, that's a great answer. It really clarifies a lot of the questions that often do come up. And with that too, you're also gaining some major benefits. Just kind of tying in the first question with the 1031. As a commercial real estate broker, starting at Marcus and Millichap years ago, I saw a lot of people get really hurt. And the reason they got hurt is because they overpaid via the 1031 exchange in a highly appreciated marketplace, and they took on a lot of debt because the 1031 forces you to buy equal or greater value if you want 100% tax deferral, which means oftentimes equal or greater debt. And so in the 04, 05, 06 market, 07, just before kind of the crash, they were overpaying for these properties, had all this debt, and then everything shifted, the market turned, and then some of them lost everything, right? And so one of the advantages with the Deferred Sales Trust, or even the intent is to take risk off the table, take debt off the table, is to get out of debt. And what's unique about the Deferred Sales Trust is you can just sell your asset, a business, high-end primary home, commercial real estate, and all of the debt is paid off at closing, and the remaining proceeds goes into the trust, and that overall lowers the risk. And so can you speak to a little bit about what's happening right now with Corona and the crisis and everything that's shifting, and why you want to be liquid, why you want to be diversified, and why you want to be out of debt?
Well, you've had a massive sell-off, and obviously, what's going on in the markets right now are, think about that. It's kind of a chain effect. I mean, your tenants in your apartments now cannot pay their rent because they don't have a job, and they're obviously in states that are getting rent relief. They're not having to pay their rents. You can't kick them out. So obviously the landlord that owns the property is struggling because that person is not receiving rent. So he has a mortgage, or she has a mortgage to have to pay. And that's becoming a problem as well. So they can't make their mortgage payment to their building, and then all of a sudden you've got a lender that may be in there that may be in a situation where they're having problems because they've put loans on this stuff, and again it's a problem. So it just trickles all the way down. So when you whether you're a lender or you're an investor in these things, or you're the actual person that is living in the apartment and you have no cash. I mean, again, anytime you have debt, you have to actually pay that debt. I mean, unless there's some sort of a government protection that you don't, you actually have to make those calls. So when I look at what happened in 2007 into 2008, a lot of these investments, like the loans that were on commercial buildings, the CMBS market, those bond pools blew up, and ultimately there was people that just couldn't make their payments, so it just kind of really it just blew up, so that ultimately just kept going down and going down to these bond pools, and then ultimately the special servicers kept selling, became the main controlling factor of these bond pools, and then they ultimately were selling properties at huge discounts. I mean, steep discounts to investors. So whether that happens again, I don't know. But again, anytime you have debt, I mean, we know that you can't just pay cash for a property. But at a certain time of your life, it's good to get out of debt completely. And so what the DST provides to you is, look, if you've got a lot of equity and you've made it, why not take it and shelter it, diversify it, get it liquid, and get out of debt. Again, 1031 doesn't give you that option, because if you have a property and you're going to 1031, you have to do like for like. If you actually have to continue to have that same type of debt, or you might have a boot issue. And so that's the problem. Not a lot of people don't know about the DST. They don't know how to kind of solidify their problems. And we think this is probably one of the best things for the American people, is as they get older, they can't make it back. If you're in your 40s and 30s and you blow up, you know what? You can start again and get back. But when you're in your 50s and 60s and 70s and you've got all this equity, you don't have the ability to come back, because you don't have the time on your side. So again, what I tell people is look, you've got a nice gain. Take that gain, get liquid, put your money in safe, hedged investments that protect you. And then more importantly, just live on that nice income that you've produced, and be thankful that you've made a great profit. So again, debt is not your friend when markets go down. It's the worst thing you could be. When markets go up, that's what debt is all about, getting cheap debt and making a lot of money off of it. So again, we think the DST is a great strategy for anybody. Doesn't matter about age, but more for the baby boomers than anybody I could say. It really should be a great strategy for you to kind of retire on, if that makes sense.
It does. And it's really moving from a place of creating wealth versus preserving wealth, right? It's shifting out of debt and really, or in debt to out of debt, and preserving what you've worked so hard for so long. And there's a time to sell and there's a time to buy. And by the way, the Deferred Sales Trust, what's beautiful about it and what I love it so much about for me and my clients is the fact that you can go back into a deal when it makes sense. You know, we just had a deal close, Bob and I did here last week, for a gentleman who sold a $7+ million multifamily property, had over $4 million in debt. And he was able to defer $1 million in tax and move all of his proceeds into the trust. And so he's out of debt. And he's sold hundreds of properties over the years. And his number one goal is just to sell high and buy low, right? And he saw that he's selling today and buying today was not very wise, because prices in real estate maybe are still high, even though Corona just happened. But he thinks it's going to really, get hit hard here in the next 12 months. And so he wants to be able to just preserve it for a while, be out of debt, be diversified, and then redeploy when and if it makes sense for him. He's also a baby boomer. He's also looking to retire, and he doesn't want all of the stress of having to own real estate that's highly appreciated, that has a lot of debt in today's marketplace. And so that was his number one reason for using the Deferred Sales Trust. But it leads into the third question, Bob, that a lot of new folks to the Deferred Sales Trust often have, and that has to do with cost. So would you kind of walk through how the Deferred Sales Trust is actually an investment? When you have a tax deferred wealth plan and you're diversified and using the strategies we're talking about, how the Deferred Sales Trust tool is actually an investment and it's not actually a cost?
Well, let me come back one step, because there's a lot of people that are getting shown these Delaware statutory trusts. I'm a financial advisor, and we don't really like them. They're high in fees. We think that a lot of them are overvalued. You're going to meet salesmen that are going to try to hype you on that, and I'm not a big believer in it. We have done it because we do it for certain things with we call bifurcation and high debt. But we do it very, very, very limited. But again, to put all your money from a property that you sold into a Delaware statutory trust, it sounds attractive that somebody else is going to manage it, but you're paying that sponsor to buy a property, put the debt on it, and then resell it to you for a profit. They're out of it. Their goal is to sell their interest out at a profit. So when they're selling it to you, they're selling it at a profit, and then they're managing it for a ridiculously high fee. And then they're paying the stockbroker, a huge amount of money to basically get your money in there. I mean, just ask any stockbroker how much money of my money is really hitting the ground in the actual physical. You might see only about 85% of your money actually really doing that. The other 15% is going in somebody's pocket. And how are you going to make money at that when, and again, we believe that's the next shoe to drop. We think that's a big concern. And, again, the other thing is they're selling you on, we can put you in Dollar General, we can put you in Walgreens, we can put you into CVS's, and that's so great. Well, you're paying a premium to get into those big, great companies. So think about the premium that you're paying to get into those things. And then the other thing is that high fee that you're paying, which is not great. And the last piece to that is really, if you're paying a high premium, what if interest rates go up? In 10 years, you're going to have to refinance that, and interest rates are higher and you paid a higher premium. What's the loan rate? There's a lot of variables here that are very risky. The other real point is what if those companies decide to go dark, meaning you put people in a CVS or a Walgreens and they decide to close the store, and they wait, even though they pay you the lease, that's great, but how do they release that to somebody else that's going to pay that premium? They're not. So when that lease ends, the shoe's going to drop on the real estate price, and you're going to lose back everything that you made over the years. So not a good scenario. We advise against it. We're really, really concerned about it. So you need to really look at that very carefully and be very careful of that. Now, back to your question on the deferred sales trust, we get you liquid, and your money. So you've got all $3 million working in this scenario, and our goal is to be an institutional. We work with institutional money managers that are liquid every day, meaning your investments are secured, depending on whatever we're investing. Most of our investments are in S&P related stuff that has hedged positions, so it protects on the downside. And then we also put it in investments that are very safe, like muni bonds and things that are conservative, depending on what your goals and objectives are. So our goals are your goals, and we want to make sure that the money is safely invested. We use very large companies, some of the biggest asset management companies in the world, and we've negotiated special rates. So we're getting institutional platform rates. My goal is to make the all-in fee less than what it would cost to be in a mutual fund. All in, including the trustee, the money management, all of the cost to be able to be less than a mutual fund. So that's our goal, is to be able to offer you, institutional rates, all in with the trustee and everything, with more money to live on. And again, that's where you start to make money, because again, our goal is to keep the fees really low and not have a bunch of built up, commission fees. Because again, we want 100% of your money working for you day one, not 85%. And again, we're fee-based management. Most of our advisors are fee-based and commission orientated, but they like fees because we think that's in the best interest of the trust and the clients, if that makes sense.
It makes perfect sense. And would you also maybe touch on the new depreciation schedule that someone could get, and how that's actually going to be a savings to them, right? If they sold a business that was fully depreciated, or sold a piece of real estate that was fully depreciated, move the funds into the trust, and should they purchase investment real estate by partnering with the trust, how now that new depreciation is actually, a big savings, right? Which could also be a nice ROI on their deferred sales trust and on their deal.
Well, again, the trust is out to make a profit. The trust is out to make money. So the trust can go back into real estate. Let's just say hypothetically you get out today and then the market's crash in real estate, and you happen to get out and you've got all this money, this $3 million, and then all of a sudden you find a property that used to be $3 million that you could buy for $1.5 million. So the trust can, actually joint venture with you to buy that property, which is great, because again, the goal is to buy something to make money for the trust and then also make money for the taxpayer. Again, the goal here is that when you buy a brand new property, under 1031 exchange, even Delaware, you don't get a brand new depreciation schedule. You stay with the old depreciation schedule that you came from all the way through. In our scenario, when we actually do a deferred sales trust and we go out and buy new property, we get a brand new depreciation schedule. And I repeat, we get a brand new depreciation schedule. That is very valuable to anybody that's listening here, because you understand depreciation, but you also understand that you can buy when the market is lower. I mean, I can't predict whether the real estate's going to keep going higher or lower, go sideways. But what I can tell you is that when you get out, we can defer the capital gains. You can sit on the sidelines, and everybody knows here that finding real estate takes time. And the longer you have, the more time you have to be able to wait, do your due diligence, take your time, and strike when the iron's hot. That's pretty valuable. 1031 does not give you that. Delaware statutory does not give you that. And what we get here with the deferred sales trust is the ability to take all the time you need, a year, 2 years, 3 years. You may not even be looking for property. You may want to just retire, but you're such a good real estate person and you've always known basic 101 real estate. So if something hits you in the side of the head and says, buy me, and it's a great buy, you're going to do that. You have to, so it's in the blood. So my point is, what's great about the DST, it offers you that ability to do that, and you get a brand new depreciation schedule when that happens. And that's going to be very tax efficient for you as you start to produce cash flow from this trust, because you can actually get a nice shelter, which depreciation does that for you. So we'll spend more time with you and kind of giving you that and designing it for you. But I just want everybody to know here that there's some very good tax efficient ways to do it. Again, when you buy real estate, the day you buy it, you made your profit. So, you don't want to just have to buy because the 1031 is forcing you to buy. You want to be able to eliminate the 1031 market and utilize the DST as your direction forward, if that makes sense.
It makes perfect sense. And I think it can't be overstated that it's a brand new depreciation schedule. Of course, you could use cost segregation too to accelerate that brand new depreciation schedule. You're getting all the advantages of if you had done a 1031 and bought a new property, and none of the disadvantage, because you're getting a brand new depreciation schedule and you're getting, I call optimal timing, buying if and when you want to. Timing is the best thing for real estate, when and if it makes sense. And then also you're taking on debt at optimal timing too, right? You don't want to take on debt high. You want to take on debt when it's low. And you can also use the trust as a down payment to leverage that. So there's lots of ways to unpeel this onion. But the point is, the deferred sales trust is really not an expense. It's really an investment for you to lower your risk, to get more diversification, to buy at optimal timing, to get a brand new depreciation schedule. And the other one I think is really unique, and maybe you can touch on briefly, Bob, it has to do with we call the net income tax advantage, meaning you may not need income today per se. For example, we're doing a large deal out of Florida, and these are very highly paid, skilled professionals who are selling their practices, and they're still working, and they're still pretty young. They're in their 40s, right? So not looking to retire, and they're planning on selling their business, moving into the trust, and allowing the trust, whatever it produces, to compound, meaning they're not going to be receiving any income today. They may in a couple years, right? But the point is, the income they're not receiving today, they're not paying tax on that right now. It's in a deferral state. So would you just touch on that net income tax advantage and how, again, that can be an investment using the deferred sales trust rather than the deferred sales trust being an expense?
Sure. Well, we operate our trust where we can defer, for a period of time. So they can just let that money grow and compound. We actually, the interest on the installment is a compounding interest, not a simple interest. So we use a compounding interest, which is great. So it just compounds. More importantly, clients can, go still work for another year or two, and that income that they produced from the trust can be deferred, and then they ultimately aren't paying tax up front. They're paying down the road. A lot of the clients will just earn money, and again, they'll pay less tax because it's kind of like almost like a 401k, but it just grows, and then eventually they'll start their installment income. So again, there's some tax engineering that can go on. The other things that we can do, which we like, and I think is really great with the trust, is an opportunity zone. There's some neat things that we do in the opportunity zone area that, again, aren't involving real estate. So we would really like to show you how the opportunity zone works. And it could, again, a lot of those opportunity zones work really well with the deferral of the deferred sales trust too. So you can start getting some principal out of your trust tax-free, and you can put some of that other money into an opportunity zone. And some of the opportunity zones that we are using aren't involving real estate because, again, you have to wait till the development of real estate is built, and then you obviously they can refinance it and start some income, and that takes a long time. Our opportunity zones start paying you income in the 13th month. You just got to wait 12 months and you get cash flow and you get write-off. So there's a lot of things that we like to try to do is to try to tax engineer a great result for you. Everybody's different. Everybody has a different goal, but our job is to try to figure out what everybody's goals are, their investment objectives, and then be able to kind of work with our tax team to kind of design and tax engineer a good result. It's not, some of the stuff it can be changed. I mean, it's not like a permanent, you're stuck, and like a Delaware statutory trust, once you're in, you're at the mercy of the sponsor and they're charging you fees, and you're kind of like a person that can't really do anything. You can't sell, you're really pretty powerless in that position. And if you're doing a 1031 exchange, you bought something perhaps too high, and now you're going to have to manage your way out of that thing. And, again, if there's a big big change in the market, watch out, because you still got to make those debt payments. And just like what's happened right now, and a lot of these tenants that bought properties now or the landlord has bought properties, their tenants aren't paying them. So again, what we like is no debt, and we like the idea of investing in things that are hedged in the market. So if markets go down, your money's losing on the right side, but the left side's actually hedging that loss on the right side and protecting you. So the stuff that we try to do is cutting edge, and we'd love to share all of that with you to give you that. But I think the DST is a really good option for people.
Absolutely. And just to clarify for some of our listeners who may not know what tax engineering is. So tax engineering is essentially receiving the income or receiving the capital, the principal balance on your gain when it makes sense for you. So if you can delay it for a couple years, perhaps you're making a larger income today, but then you're retiring in a couple years. Well, you delayed it on the trust and you start to receive it in a few years when it makes sense. So on one side of the ledger, your personal income has gone down when you retire, and then you start pulling from the trust instead of having both of it paying you at the same time and having a higher tax bracket. So we like to say, it's your money. We owe it to you. It's owed to you from the trust. How and when would you like to receive it? That's the best way, most profitable way for you, again, so that the deferred sales trust is not an expense. It's actually really an investment, which also kind of leads to the other part of this too is the way you can structure the notes. So some notes can go for 3 years, some notes can go for 5. Most of our notes on average go for 10 years. So it's interest-only payments, and then the balloon payments due at the end. But for some listeners or some deferred sales trust potential clients, they may want a shorter time period, and knowing that, hey, it's all going to be paid back sooner, right? And then also the liquidity part, just to clarify that. If the investments are in stocks, bonds, mutual funds, securities, and if they're in a particular account, they can be trade plus 3, meaning you have access to the funds, versus illiquid assets such as the Delaware Statutory Trust or such as investment real estate. It may take a refinance event or selling, which could be months and months and months. And so the liquidity part is also just to clarify some terms there. So with that, Bob, I think that kind of wraps up the show. Any last thoughts for our listeners here before we let you go?
No, I think again, again, a lot of people don't know about the DST. Why haven't I heard about it? I mean, we've been operating the DST for now I've been doing it 21 years. Our tax team has been doing it for 24 years. I just want everybody to understand that we've been around a long time. The IRS has reviewed this. We've done many transactions over the years and all different types of asset classes. So we have lots of references, lots of tax attorneys across the country, lots of CPAs across the country, even former IRS, agents that are now working in private practice can tell you that, their knowledge about it. So again, we have lots of references to be able to speak to help you, guide you in this process. So, we're here to help you. We're here to give you good sound advice and see what makes sense. It's, we're not, trying to push you the DST. We're trying to be open-minded about everything and try to give you the best ideas possible to help you and your family make a good decision. So whatever that is, we'd love to hear from you. We'd love to talk to you, and see how we can help. So great to have you watch our presentation today. And we thank you, and everybody stay safe. And we'll get through this.
Well, thanks, Bob, for being on, and thanks for being a good friend, a good mentor, business partner, and all that you do to help people escape feeling trapped by capital gains tax. And I also want to thank our listeners for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy, such as the Deferred Sales Trust, is the best way to grow your wealth. Hey, take action today. Go to capitalgainstaxsolutions.com, and you can click on schedule a free conference call, and you, me, and Bob can all get on a call to discuss your particular deal and or your next step towards your tax deferred wealth plan. And until then, please share this, like it, and subscribe.